So here I am at the bookstore, and I came across an interesting book called The Federal Reserve and the Financial Crisis, lectures by Bernanke. So I thought I would take a minute to thumb through it and see what was actually going on and hear his lectures and his take on the whole economic crisis over the last decade of pretty much the economy being under his reign prior to Janet Yellen. Just to give an idea of what's going on, it says in 2012, Bernanke, chairman of the Federal Reserve, gave a series of lectures about the Federal Reserve and the 2008 financial crisis as part of his course at George Washington University on the Fed's role in the economy. In this unusual event, Bernanke shed new light on the central bank's crucial actions during the worst financial crisis since the Great Depression. So it lists a couple of quotes here as the review of these lectures. So basically just thumb through it briefly, and one thing I noticed automatically is the idea that it says debt and then America with Bernanke in front. So take a quick minute, thumb through it, and give you an idea what's in it, get his take on what happened in the global economy, and then let you see if his version lines up with the truth. So keep going here. I want to make this short and quick because this is a very small book, about 103 pages. And then lecture 1, Origins and Mission of the Federal Reserve. Lecture 2, the Federal Reserve after World War II. And then lecture 3, the Federal Reserve's response to financial crisis. And lecture 4, the aftermath of the crisis. And so let's thumb through and get his take on what's happening here. And it says, publisher's note. The material in this book was originally delivered as a series of lectures by Bernanke at George Washington University in March 2012. This book is taken from the transcripts of the lectures and has been edited for readability. Videos of the lectures and presentation slides are available online at federalreserve.gov/news events/lectures. So if you're interested, you can go online and get more information for yourself. So let's get to the first lecture and get some thoughts as to the origins according to what he says. He says, in his first lecture, I will not touch on the current crisis at all. Instead, I will talk about the central banks are, what they do, and how central banks got started in the United States. I will talk about how the Fed engaged with the first great challenge, the Great Depression of the 1930s. In the second lecture, I will pick up on the history from there, yada yada. Let me see what else he has on there. What are the tools that the central banks use to achieve these broad objectives? In very simple terms, these are basically two sets of tools. On the economic stability side, the main tool is monetary policy. In normal times, for example, the Fed can raise or lower short-term interest rates. It does this by buying and selling securities in the open market. Usually, if the economy is growing too slowly or inflation is falling too low, the Fed can stimulate the economy by lowering interest rates. Lowering interest rates can feed through to a broad range of other interest rates, which encourages spending on the acquisition of homes, for example, and on the construction investment by firms and so forth. Lower interest rates generate more demand, more spending, and more investment in the economy. That creates more thrust in growth. So that's the Keynesian model, that you spend your way to grow. Interesting. There's a third tool that most central banks, including the Fed, have, which is financial regulation and supervision. Central banks usually play a role in supervising the banking system, assessing the extent of the risk in their portfolios, making sure that their practices are sound, and in that way trying to keep the financial system healthy. It says the main tool of central banks for dealing with financial panics or financial crisis is a little less familiar, the provision of liquidity. In order to address financial stability concerns, one thing that central banks can do is make short-term loans to financial institutions. As I will explain, providing short-term credit to financial institutions during a period of panic or crisis can help calm the market. Interesting. So thumb through a little bit more, see what he has to say. It says panics can be a serious problem. If one bank is having problems, people at the bank next door may begin to wonder or worry about problems at their bank. And so a bank run can lead to widespread bank runs or a banking panic more broadly. Sometimes pre-FDIC banks would respond to a panic or a run by refusing to pay out deposits. They would just say, no more, we're closing the window. A financial panic can occur anytime you have an institution that has longer-term liquid assets. Illiquid in the sense that it takes time and effort to sell those loans, and it's financed on the other side of the loan sheet by short-term liabilities. So, giving a little jibber-jabber into the Federal Reserve. And so let's talk a little bit specifically about the United States and the Federal Reserve. The Federal Reserve was founded in 1914. Concerns about both macroeconomic stability and financial stability motivated the decision of Congress and President Woodrow Wilson to create it. After the Civil War and into early 1900s, there was no central bank, so any kind of financial stability functions that could not be performed by the Treasury had to be done privately. Yeah, in the end, though, these kinds of private arrangements were just not sufficient. So yeah, so interesting here. And then we have an idea of what the bank runs look like. And so in 1873, there's about 100 bank closures. 1884, there was about 50 bank closures. So it gives a little chart here of the total bank closures prior to the Federal Reserve, kind of leading up to the idea that the Fed was a primary reason there haven't been many bank closures since then. So 1893, there was about 500. 1914, there was about 150 or so. So it says there are other concerns with the gold standard. One of these gold standard does is create a system of fixed exchange rate between the currencies of countries that are on gold standards. For example, in 1900, the value of the dollar was about $20 per ounce of gold. At the same time, the British set their gold standard at roughly 4 British pounds per ounce of gold. $20 equals 1 ounce gold, and 1 ounce of gold equals 4 British pounds. So $20 equals 4 pounds. Basically, 1 pound is valued at $5. So essentially, if both countries are on the gold standard, the ratio of prices between the two exchanges was fixed. There's no variability, unlike today when the euro can go up and down against the euro. Again, some people would argue that it is beneficial, but there's at least one problem. If there are shocks or changes in the money supply in one country, and perhaps even a bad set of policy, other countries that are tied to the currency of that country will experience some of the effects. So basically downplaying the idea of gold in the system. Then it says, finally, one of the strengths that people cite for the gold standard is that it creates a stable value for currency. It creates a stable inflation. That is true over a very long period, but over short periods, maybe up to 5 or 10 years, you can actually have a lot of inflation or deflation with a gold standard, because the amount of money in the economy varies according to these things like gold strikes. So, for example, if gold is discovered in California and the amount of gold in the economy goes up, that will cause inflation. Interesting. Whereas if the economy is growing faster and there's a shortage of gold, that will cause deflation. This was a very significant concern in the United States. In the latter part of the 19th century, there was a shortage of gold relative to economic growth. And since there was not enough gold, the money supply was shrinking relative to the economy. The U.S. economy was experiencing deflation. And this is price gradually falling over the period of time. Interesting. So this is his Ben Bernanke's lecture. Here we have a couple graphs here. And it shows here December S&P Composite Equity Price Index declining. More graphs, percentage change. We have the shaded represents years of the Great Depression. So we have negative percentage change. Percentage change here we have Consumer Price Index during 1925 to 33, negative. Unemployment rate during the Great Depression, up here, came back down. So yeah, he does a good job of trying to validate the reason for having a Federal Reserve Bank. Here we have number of failures per year, bank failures. And so here it shows that it was a build-up up until the Great Depression, but yet after the Great Depression, not many. So, interesting here. Federal Reserve after World War II. Here we have a consumer price index, inflation. 1960 was about 2%, up to 1980 about 12%. Yeah, so full of graphs, charts. His explanation as to why the crisis happened, not pinpointing anything to do with the Federal Reserve Bank. So here we have non-prime mortgage originations declining up into 2008%. Here we have the percentage of non-prime loans with low documentation on an increase. Percent of disposable income crashed. What else we have here? Prices of existing single-family houses crashing. So this is all leading up to the crisis under his watch. Here we have the mortgages with negative equity, 2010 and above on the rise. Mortgage delinquencies, 2009 and below, heading down. So just a look inside this book here. A lot of graphs pinpointing and bringing news to the whole Federal Reserve. Bernanke look into the Great Depression. So, you know, if you're interested, definitely could be something worth checking out. But I would probably recommend, if you want to find out more, go to the online presentation. Save your money on buying this book. It's www.federalreserve.gov/newsletters/lectures. So, quick little inside look into this book here, the Federal Reserve and the Financial Crisis. So, scroll below, leave me a comment, let me know what you think. And other than that, you know, just to look inside. So, hope you enjoyed it. Thanks.